Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 4-1 question number 1. This is a structured paper 4 which consists of 2 questions. Each of them will be of 25 marks and the total time limit given for this paper is 1 hour, which means that ideally you should be spending about 30 minutes in order to solve each question, and in this video as well we'll be attempting to solve this question under 30 minutes. So without any further delay, let's get started. Barry has performed a survey of Farmers Field, which is on the site of an ancient settlement. He has government permission to dig up items from that settlement and sell them to museums around the world, as long as he pays a percentage of the proceeds to the government. We're given the following information. Payment to the farmer for the right to dig in the field for 4 years. This is 100,000, all paid before the dig starts. So this is basically our initial cost. Then estimated sales proceeds from museums is 500,000 over 4 years. So that's the total for 4 years. And proceeds are expected to be received in line with the progress of the dig. So we must be given information right here. So we're given progress of the dig right here. I'm just going to figure out the amounts as well. So we have 0, 1, 2, 3, and 4 years. Let's start with the proceeds. And proceeds are basically our income. So this is the cash inflow. Now, this is in line with the progress of the dig. And the progress of the dig for the first year is 45%, which just means that we receive 45% of 500,000 in year 1. That is just going to be 500,000 multiplied by 45%, which results in the value of 225,000. We repeat the same process for years 2, 3, and 4. For year 2, that will be 500,000 multiplied by 25%. This results in the value of 125,000. For year 3, that's 500,000 multiplied by 20%. This results in the value of 100,000. For year 4, that will be 500,000 multiplied by 10%. This results in the value of 50,000. Okay, we're all done with our estimated sales proceeds. Then there is payment to government as well. So 10% of proceeds paid in the year in which the proceeds are received. So we need to pay 10% of the proceeds to the government each year. So we can just figure out the government expenses as well. That's going to be 10% of 225,000. So that's 225,000 times 10%. And for year 1, we need to pay 22,500 to the government. Similarly, for year 2, that will be 125,000 times 10%, which will be 12,500. For year 3, that will be 100,000 times 10%, which will be 10,000. And for year 4, that will be 50,000 times 10%, which will be 5,000. And remember that we need to pay this to the government, which means that this will be our outflow. So these are the negative amounts. Okay, and then we're also given the costs. All right. Now, Barry uses a cost of capital of 10%, and the discount factors for this rate are as follows. Let's have a look at our first question. We need to calculate the net present value of the dig. All right, let's write down our years. That's 0, 1, 2, 3, and 4. We can just start with our net cash flows. Okay, for year 0, it is just going to be our initial cost, which is given to be 100,000. And this is a negative cash flow since we're paying out this amount. Now for year 1, we need to figure out the total. So remember that proceeds are inflows, so that's our positive income. That's 225,000. Then we need to pay 22,500 out of this, right? And then we again have a cost of 116,500 for year 1. So the net cash flow for year 1 is just going to be 225,000 minus 22,500 minus 116,500, which results in 86,000. For year 2, that is just going to be 125,000 minus 12,500 minus 98,500, which results in 14,000. Then, for year 3, that will be 100,000 minus 10,000 minus 67,000, which results in the value of 23,000. And for year 4, that is just going to be 50,000 minus 5,000 minus 23,000, which results in 22,000. So let us also figure out the total of net cash flows, because that is just going to be our total profit. So it's negative 100,000 plus 86,000 plus 14,000 plus 23,000 plus 22,000, which results in 45,000. Now we just need to write down our discount factors. And always remember that the discount factor for year 0 will be 1 regardless of our cost of capital. In this case, the cost of capital is 10% and the discount factors are 0.909, 0.826, 0.751 and 0.683 for years 1, 2, 3 and 4 respectively. Let's write it down. So for year 1 it was 0.909, for year 2 it was 0.826, for year 3 it was 0.751 and for year 4 it was 0.683. Now we just need to figure out our discounted cash flows. And discounted cash flows is just the product of net cash flows and the discount factors. So for year 1, that is just going to be negative 100,000 times 1, which is still negative 100,000. Now the discounted cash flow for year 1 is 86,000 times 0.909, which results in 78,174. For year 2, that will be 14,000 times 0.826, which results in 11,564. For year 3, that's 23,000 times 0.751, which results in 17,273. And for year 4, that's 22,000 times 0.683, which results in 15,026. Now, in order to figure out our net present value, we just need to add all of our discounted cash flows. So in this case, that is just negative 100,000 plus 78,174 plus 11,564 plus 17,273 plus 15,026, which results in the value of 22,037. That's the net present value that we require. This concludes the first part. Let's move towards the second one. We now need to figure out the payback period as well. So remember that payback period is just a period in which we get our initial cost back. So we can see that our initial cost is 100,000. In year 1, we receive 86,000 back. So the remaining amount is just 100,000 minus 86,000, which is 14,000. Now we need to get this 14,000 back. And we can see right here that in the second year, we'll be getting 14,000 back, which just means that we get all of our initial investment back within 2 years. We can also show this right here. So we have our year and we have our amounts. So the initial one was 100,000. For first year, we got 86,000 and for second year, we got 14,000, which resulted in the total balance to be 0, which means that we got our initial investment back after 2 years, and 2 years will be our payback period. All right. Now for the third one, we need to calculate the accounting rate of return. And remember that the formula for accounting rate of return is just our average profit divided by average investment into 100%. Now let us figure out our average profit. We have already calculated the total profit above. That was just the sum of our net cash flows for the 4 years and our initial investment. So the total profit was 45,000 and the total number of years in this case is 4. So we just need to divide 45,000 by 4 in order to figure out the average profit. That's 45,000 divided by 4, which results in 11,250. Now for average investment, we just need to divide our initial investment by 2. And the initial investment was 100,000 in this case. So our average investment will just be 50,000, which means that the accounting rate of return will be 11,250 divided by 50,000 into 100%, which results in the value of 22.5%. This concludes the third part. Let's move towards the next one. Now we need to advise Barry whether or not he should go ahead with a dig in the farmer's field. We need to justify our answer. Okay, so this is of 7 marks, which means that we need to write down at least 6 considerations. Alright, we can consider the values that we have calculated. So for the first part, we calculated our net present value and we can see that it has a positive amount. So we can see that it would be financially beneficial if Barry were to invest in this project. Let's write it down. The NPV is positive, which indicates that it would be financially beneficial. Now, the second thing that we figured out was the payback period. And remember that payback period is 2 years, whereas the total time for this project is 4 years. So we can see that payback period is short, and this indicates lower risk. Let's write it down. The payback period is short, which indicates lower risk. Then the third thing that we figured out was our accounting rate of return, and it was 22.5%, whereas our cost of capital was only 10%. So we can see that ARR is in excess of the cost of capital. The ARR is in excess of Barry's cost of capital. So we know that NPV was positive, and also remember that NPV method is considered to be the most reliable method. So we can write that down as well. The net present value method is considered to be the most reliable method. And if it's positive, it just means that Barry should invest in this project. But this project is to dig up items and sell it, right? But he cannot be certain of the quantity as well as the quality of the items he plans to dig up. That's a risk he will have to bear. So Barry cannot be certain of the quantity and quality of the goods or the items he plans to dig up. And he also cannot be certain of the proceeds from the museums, right? Because museums may have limited budgets and they might not be able to buy the items that Barry wants to sell. Let's write it down. Barry cannot be certain of the proceeds as museums may have limited budgets. Okay, so we have written down 4 considerations. Now we need to advise Barry on whether or not he should go ahead with the dig in the farmer's field. So personally, I would advise Barry not to go ahead with this project because regardless of the short payback period and positive net present value, it is inherently a very risky venture because he basically plans to dig up the items, right? And he does not know the condition of the items or the quality of the items, and he does not even know whether or not the museums are certain of buying all of the items that he digs up. So he cannot be so sure of the profit as well. It's all estimates. So my decision is that Barry should not go ahead with the dig in the farmer's market. Oh, sorry, farmer's field, as this is an inherently risky venture. Alright, that's all for the second part of this question. We can now move towards the third one. We now need to state 2 disadvantages of using ARR for investment decisions. So the very first thing is we do not use any of the discount factors while calculating ARR, which means that it ignores the time value of money. So it ignores the time value of money And the second thing is that it also ignores the timing of cash flows, since it does not need to apply any sort of discount factors to the amounts that we have received as our net cash flows in different years. So it ignores the timing of cash flows. Alright, this is all for the third part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.